Hi, and welcome back, everyone, to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thanks for joining us here every week where we talk about everything that's going on in the market and everything we see coming up this week. And today we're going to take a bit of a dive or a deeper look into the G7 meeting that just happened and give you some updates and what the outcome from those discussions were and what it means for the markets and Canada specifically. With that, though, as always, keep in mind everything we talk about here is for educational purposes only. Always do your own due diligence or talk to a professional advisor before implementing any strategies into your portfolios. And you can always reach us at mikeonmoney.com. Happy to answer any of your questions and tons of information there, access to our other portals if you want to do some of your own education and research there as well. If you're watching us live today, you can always click that Q&A button to ask you any questions. If you're watching recorded or on the podcast, as always, as I mentioned, mikeonmoney.com. Send in your questions. We'll make sure we get back to you right away with answers and any additional information that might be helpful to your particular situation. With that, let's dive into what's going on in the economy. Busy week this week. We're looking for CVS Health Investor Day, US PPI numbers for May, US retail sales for May, US industrial production for May, and also Canadian housing starts coming up for May. So all those numbers are expected out. Not really looking for any huge surprises. I think we got some early looks on the retail sales. We're a little bit below expectations. But again, if you follow these on a weekly basis, or even if you catch them every month, as we see some of these numbers come out after the reopening, we are 100% expecting some of the numbers to fall off from their peaks of the reopening, because of course they're just being measured against the previous month and the previous month before that. So as we come out of complete closure to reopen, the numbers were getting bigger and bigger. And now things are leveling off. So not necessarily disappointing results, but a little bit lower than maybe some people expected. But that's not surprising. As we've talked about the inflation numbers that were higher expected for the short term, we wanted those to level off for a little bit. And what's going to level them off is a little bit slower sales as the real economy starts to take over. And we start to see real growth come back into those economies. So nothing really to be worried about there. And in fact, the market stock futures hedged a little bit higher, just on that data, kind of absorbing that, and also really taking, the market's starting to turn their eyes a little bit to what the restaurants and hospitality industries are doing as we start to see those things start to reopen as well. Investors' expectations that the stock will climb through the rest of this year are easing a little bit on monetary policy. And this again goes right back to the inflation numbers. We're starting to see the bottleneck in the supply chains, some of those restrictions being dealt with. Hopefully it's just temporary. We see that start to build back up. And I have talked to actually some those involved in supply chain and in manufacturing. And while they had massive demand, which caused the bottleneck, they're seeing that demand fall off as the retailers stocked up their inventories, right? They put in big orders because they were having big, the sales numbers were going up. They've completely filled their inventories, and now they're seeing that slow a little bit, as we saw by the retail numbers, and they've got to eat through that inventory that the retailers have built up. Which all means a good thing for the supply chain and for the manufacturers, so they can get caught up because they were pretty much pressed, which will also means the delivery lead times for goods, which we've seen skyrocket, especially if you're doing anything around home renovations or home construction. Hopefully start to see those things level off again and go back to the norms, something reasonable that we can all live within. To mention the inflation numbers, we are expecting them to flatten off, and so is the reserve. I've talked about the US Fed and Canada have a target of 2023 before they have to raise rates. Fed has kind of hinted at 2024, although the street is pretty much not ridiculed, but quite surprised that they would think out into 2024, given what's going on. And we're going to have to see how that plays out. We're really going to have to pay a lot of attention to the language we hear out of the US Fed and the policy committees, because that's what's going to really telegraph where they're thinking and when that move is going to happen. So language is going to be really important, and the markets are going to be very, very sensitive to language coming out of the US Fed and the community. Back to the future, 2022, is it going to echo the roaring 2020s, or are we going to see the inflationary numbers of the 70s? That's the big question right now. Of course, we had the roaring 20s. Everyone was drawn into the rush. We saw markets rally. We saw the economy boom. Is that what we're headed for in the next decade or the next couple of years? Or are we going to be facing this inflationary pressures we saw in the 70s going into the 80s? I don't think, this is the debate that's going on. I really don't think we're looking at a 70s scenario. A lot of things have changed since then. Even the Fed and the Bank of Canada's abilities to deal with interest rates, used to be all by auction. Now they manually set them. There's a lot more data coming in, a lot more forecasting happening. So I don't think we're going into the hyperinflationary periods of the 70s, but it might be a touch and go versus the roaring 20s, because we do have to, almost orchestrate a soft landing of inflation here. The economy and the markets have to get off the monetary easing that the governments have put out, while at the same time start the underlying economy growing to be able to absorb some interest rate hikes. So as we head into the next couple of years, that's going to be the balancing act. And as I mentioned before, I don't think we're going to start to really see the impact of that into 2022. Europe and the US is nearing a jet subsidies pact. So this is an ongoing dispute over aircraft subsidies and tariffs between the US and Europe for about 17 years. China's been involved into this as well. But at the G7, Europe and the US looks like, and it's supposed to be announced later today or tomorrow, that they've come to a deal to end the tariffs and come up to an agreement on the subsidies levels or maximum levels that the aircraft industries from both countries or both regions can enjoy. But they've kind of cut out China from this, and they've agreed to deal with China as a combined effort on their subsidies. So we're going to have to see what that looks like. It's an interesting way to approach by cutting China out. Of course, China is not in the G7 discussions, and there's a lot of other issues going along with China around dumping, product dumping, manufacturing dumping, and obviously subsidies for certain industries. So we'll get those details hopefully later today, if not tomorrow morning, on what that deal looks like. But good for the US and Europe in the sense that they'll be ending this 17-year tariff war. What's at stake as far as the US debt ceiling, which is looming as they run out of money again, so they have to go back to Congress and the Senate to get approval to raise the US debt levels in order to pay all their bills. And of course, they have that $6 trillion stimulus package when it comes to this is the stimulus not out to individuals, but more into infrastructure spending and growth spending for the economy. We're going to have to take a look at what that means. Pretty much the market is basing that the US can absorb this, especially at the incredibly low interest rates that they're at right now. In fact, in some cases negative, or some periods negative. We'll have to see how that continues to go. Obviously, there's an end game to this. At some point, all the stimulus money has to stop growing and let the economy take over, and that's what they're hoping to achieve this year and into next year. The feds are tiptoeing around to taper stage months to curtail their curtain call. So this is all around the Federal Reserve buying up debts or U.S. debt to keep that liquidity in the market. As I mentioned, there has to be an end game to that. And at some point, they have to let the market start to absorb these bonds out there and let the financing happen in the open market. Very likely by third quarter this year. But again, we're going to have to keep a very close eye on the US Fed's language as they get to that point. Shell is weighing a blockbuster sale of their Texas shale asset. So this continues on. We've talked about Exxon and other major oil companies, really the board of directors, the shareholders, looking to shift the focus of the companies away from fossil fuels and into other technologies, into other energies. So Royal Dutch Shell is reviewing its holdings and looking to possibly sell one of their largest fossil fuel shale properties in the United States, as they're looking to slash carbon emissions and look at earnings, 2030 and beyond. As I mentioned, some of the most bullish outlooks still had the fossil fuel industry in a unrecoverable decline by year 2030. Not meaning it disappears, just simply that the demand for it would be in a declining state and unrecoverable, given other technologies that are making their way to the forefront. So a lot of these big companies are looking beyond 2022 and into 2030 and saying, what is our company going to look like then? Which assets do we want now? Which capital do we want to deploy into other technologies, into other areas to make us a going concern and remain one of the largest energy companies in the world going forward? And that's what we're seeing with Exxon and Royal Dutch Shell doing the same. JP Morgan is starting to stockpile cash, sitting on about 500 billion, which is a lot of money, but not all that much for JP Morgan. They're probably going to raise that a lot more through 2022, just looking to take advantage of a higher interest rate. So whether to jump on opportunities that creates in the equity markets, or taking advantage of some on the debt side once the rates start to increase. So we'll keep an eye on them, and of course the other institutional money managers as to how much money as a percentage of their capital they're starting to raise in the cash. Loeb's U.S. hedge fund, Loeb's U.S. hedge fund Third Point, which owns Vivendi, is also looking at selling off that media giant stake that they have around Universal Music to a rival billionaire. And this is just a move to free up some capital and focus more on core business. As far as COVID goes, the news continues to get better. Of course, we heard yesterday the phase 2 of our reopening, or step 2, I guess, in BC, are reopening so we can travel again. Groups up to 50, we can get together with some more friends. Things are looking better and better. The percentage of vaccines in BC continues to lead in Canada, but the rest of the country is moving along as well. We've seen Ontario start to reopen, and good for our friends out in Ontario. They've had a really tough go. Quebec is going into the next stage of reopening as well. All very positive, and the percentage of those vaccinated continues to increase in Canada, well past a lot of countries around the world, which is great news. And most people I've talked to are well into scheduling their second dose of the vaccine if they hadn't already gotten it. So no bad news on that front of BC. Obviously, still concerned over the variant. The UK, the Delta variant in the UK has caused them to not backpedal, but certainly slow down the rate of the reopening, as there's a little bit of concern of that. But I did see some preliminary research this morning just on the vaccines that while the Delta variant, the people who have been fully vaccinated are getting the Delta variant, certainly not in the same rate and numbers as those unvaccinated, but also I believe, and don't quote me on this, I've got to continue to read a few of the research reports on it, but this morning I believe that the research showed that none of those who had both vaccines were hospitalized. So yes, they got COVID, but in a much milder form, and so they wasn't required for them to be hospitalized, and obviously in that case no deaths. So that's still early on in those research, but that's still a great outcome if the vaccines are protecting us to the point, even to some of the harsher variants that are out there today. Take a look at the US. As I mentioned, they've got a lot of news coming up this week. The Federal Open Market Committee is getting together to talk about interest rate policy in Washington. And this is the language we're going to have to pay very close attention to over the next little while, just to make sure we see what's any change in that language. We know what their messaging is today, but if we start to get hints that they might change their timelines or tighten those timelines, or become more aggressive, then we'll have to watch very closely what that means for the market, especially around the growth stocks, as they'd be more heavily impacted by interest rate hikes. In the next 12 months through May, also we want to take a close look at the labor numbers and the consumer price index. Excuse me. As we see those numbers out, they're still inching up slightly, or expected to inch up slightly, which is positive. But as you can see, the demands numbers go to 6.3 versus 6.2. PPI raising to 0.6 for May, same level as April. So things are starting to flatten off, which is positive, because now that's where the real economy can start to take over. Oracle is expected to post a rise in fourth quarter revenue as their hybrid model for their cloud service serve them quite well as customers revise their spending through the COVID-19 pacing up as things start to reopen. So Oracle looks like they pivoted well, both going into the shutdowns and into the openings as well. Also in the US, electric truck maker Lordstown, the CEO and CFO both resigned on the same day. If you don't read anything more about that article, that does not sound like good news. And of course, the shares slumped. But basically, they came out and said they don't know if they have enough money to stay afloat for the next year. Obviously, not strong for the share prices. So, just an example, obviously a very high growth industry. Electric vehicles, and especially in the trucking side of things, a lot of opportunity there. But always know what you're buying, always know the balance sheets, and always make sure that your companies are funded, or at least have cash flow enough to keep them funded until revenues start to rise. On a more successful note, Novavax, a COVID-19 vaccine manufacturer, effective rate through the U.S. trial is at around 90%, which is great. It's showing high strength against the variants in the late stage US trial. Obviously, the variant trials are still very early, but it shows well for Novavax, which be another vaccine to the market, and Canada's got close ties to them for future vaccines, because this will very likely be an annual shot that we'll all have to get to keep the numbers low and to keep COVID-19 at bay. Musk came out, of course, he's tweeting about Bitcoin. He came out and said that he would reintroduce the ability to buy a Tesla with Bitcoin if the miners use more clean energy. Of course, this goes just back to the blockchain technology. All right, that's the basis of all transactions behind Bitcoin, or all cryptocurrencies. Is very energy intensive. And of course, a lot of that energy is not necessarily clean energy, a lot of coal burning in there. So Tesla moved away from Bitcoin a few weeks ago, just on the fact that it wasn't in line with their clean environment view. But now he's come out and said he would re-look at that again if miners start to use cleaner energy. Really, that means nothing, as everything he tweets about Bitcoin should not mean nothing as far as to whether or not you want to invest in Bitcoin. However, he's out there and he likes to move the markets when he can. U.S. Supreme Court is revives LinkedIn's bid to shield personal data. So this is an ongoing battle between LinkedIn and a rival called High HQ Labs. Basically, High HQ wants to go mine all data in LinkedIn so they create profiles for marketing use, for targeted marketing, and be able to sell that data, basically. And LinkedIn has been battling that in court to protect the privacy of its users. And the Supreme Court has protected LinkedIn's or took LinkedIn's side in that bid to shield that data. The US FDA has recently just declined approval of Avenue for its formula for a non-opioid painkiller. Obviously, would be great if there was an effective painkiller that was non-opioid based, given the opioid crisis that we're facing globally, but also here in North America very dramatically. Tragically, we've lost many individuals across all walks of life to the opioid crisis. But unfortunately, the FDA denied approval for the second time, sending the stocks tumbling. And this is the challenge anytime investing through biotech. You just never know what approvals or the trial outcomes are going to be. And if it's positive, it can mean good things for the companies. Of course, negative can seriously affect the stock prices, especially when you're talking about the developers. If you want more diversified exposures, you can look at things like Amazon and Johnson & Johnson, who, through a very diversified revenue base, aren't as negatively affected when one of their drugs or one of their research avenues don't pan out. Coming up in Canada, the CMHC is coming out with the housing start numbers. We are expecting it to rise slightly in May over April, but again, plateauing a little bit. Nothing bad there, just that surge slowing down, and of course, concern over ongoing lending rates. But we'll get those numbers out later this week. Canada's top news: Enbridge oil line scores a key win in a court in the U.S. over one of its replacement bids for one of their lines. This is just another saga in the ongoing pipeline battles with all the pipeline companies, whether it be TransCanada Pipeline, Enbridge, Inter Pipeline. They all seem to be in battles these days to either build new pipelines, replace old pipelines, but obviously big environmental issues at every turn on any of those projects. Canada's April factory sales were down about 2.1% on autos. Again, that just goes to the retail numbers. Not overly concerning. We did see a massive surge when the economy started to reopen on auto sales after being dead through the closures. So just another indicator that things are starting to level off. Talking about sagas, of course, the Huawei CFO is continuing the legal battles and is looking to ban the publication of HSBC documents in the US extradition case. They believe that they're privileged docs from HSBC. HSBC has already released those to the Canadian and US prosecutors, and they want to use them in court. So we'll get the outcome of that ongoing saga as more news comes out. On the exchange front, the US retail sales and industrial production price data that we started to see today and more coming out tomorrow is showing signs of a bit of a rise in inflation. So we're seeing a little bit of flattening in the US Fed and probably some scaling back to those monetary easings earlier this year than expected. So instead of a decline in the US dollar, a more flattening trend going forward. The Canadian dollar holding at 81.99, but just below the 82 level. And the bond market pulled back a little bit, not much, just under the 1.5%. Commodities, we did see oil rise, hitting almost 72 a barrel, up from just under 69 from last week. So continued strength on the reopen expectations there. Copper fell from its highest levels, almost down to its lowest level since April. I don't think that means an end to the demand on copper. It just was at an all-time high. So some profit taken there and a little bit of leveling off as well. So let's take a look at what happened in the G7. And if you're interested, I think they are selling these figurines, all hand painted if you want to order your set. I found this picture very funny that they came out with the G7 group all standing socially distanced. I guess we should thank them for setting a good example, but it does seem a bit awkward for them to get together. Some of the common stuff that came out of the G7, of course, there was a big push. We've talked about the vaccine, and it's great that the developed countries like the G7 are so far ahead and can get in their populations vaccinated, but there's the rest of the world that we really need to address before we can say that this thing is beat. And they got together and committed to almost 1 billion doses of COVID-19 vaccines to be donated to the rest of the world as we look to expand the global percentage of those fully vaccinated. So that was good out of there. Also, we've seen a pledge to around the greener technologies, so to phase out the coal-fired power generation and go to the newer, cleaner coal burning and other cleaner fuels to provide energy for the world. Of course, the US has been big behind that. We've seen Germany for years has been pushing towards that. And of course, Canada as well in the G7 all have committed to cleaner energy moving forward. The one thing they didn't dive into, though, if you do look at Germany as a test case, Germany was really early onto the wind and solar power. And if you followed me talking about this stuff, what makes it really attractive now, or really meaningful now, because it's not just leaders or it's not just people asking for it. We're now at that tipping point of cost where industry wants to shift, because it is becoming at this point cheaper, and it will moving forward become cheaper to use the alternative energies versus the traditional dirtier or more harmful fossil fuels. So Germany, however, started doing this earlier, before we were at that tipping point in pricing, and it did cause their economy to slow a little bit because the energy cost was higher, and of course the market had to bear those higher costs and absorb that over time. So it's almost a test case to look what great that they took a leadership role and moved into that for the right reasons, but from an economic recovery standpoint, you need to be cautious about which technologies, that cost realization, to make sure they're not driving up the energy prices and stalling the economies, especially at a very sensitive point right now of a recovery. So it's great they've committed to move that forward through to 2025 with some pretty ambitious goals, but at the same time, it'll be really interesting to see what the real action plans are with the money that they've pledged and how they're going to achieve that and what technologies are going to win out. So something to keep a close eye on that they didn't really dive into any real details around, but I think important factor to consider. Of course, the big theme was America was back at the table. Joe Biden showing up to ease a lot of the friction that Trump and his administration had kind of created with the G7 allies, being much more collaborative, especially on things like environmental issues, but also around tax. Of course, one of the things that they got together, of course, is that global flat foreign tax, which is also very good. But again, not a lot of details of that implementation. They're all headed back on what they're going to do with those agreements, but how that's going to be implemented and who it's going to affect is going to be the big thing. Obviously, the target is the big conglomerates. The tech companies are highly focused in that, but are they going to throw a big net and catch a bunch of small fish is what we have to be very careful about, because again, you don't want to stymie growth, right? One of the things that wasn't on the table that you kind of wanted to see is how to get rid of bureaucracy and regulation around a global market or global growth economy. We talked last week about the synchronization we're seeing in global economies in this recovery. Well, how do we keep that going? How do we keep the barriers down? The tax is fair as possible, 100%, but also not so much that it's going to impede growth. So that really wasn't discussed. So again, we're seeing some lack of detail coming out of the G7, which really that's what the meat of this is, or what we need to see coming out here. Human rights, of course, was at the forefront of discussion, as it should be when these countries get together. And they did kind of, again, come up with a very broad agreement to work together to work with and in some ways against China around their human rights. You know, all those protests we saw pre-pandemic in Hong Kong and all those issues are continuing to go on, not just around the Hong Kong new legislations and rules that they put into place, but China as a whole. And the G7, of course, have agreed to work together to battle that, whether it's through sanctions or through negotiations with China. At least there's a unified front amongst them. And Russia came up a lot in those discussions as well. Obviously, a lot of concerns of the destabilizing moves that Russia has made, especially in areas around Europe, as they continue to face sanctions from the G7. They've committed to be a unified front against a former G8 member. As I mentioned, of course, the unified tax agreement that they come up with, the minimum 17% corporate tax rate, mainly targeted around the different corporations, especially in the tech sectors. So with that, I'm going to keep it short this week. I know usually I blather on a lot, but I have to admit the G7 wasn't as excited as we were hoping. It was been very general, but some great information and great policies that hopefully the countries will continue to build on. We'll keep you informed with that. Also want to keep you advised, we are our next episode in Bitcoin is coming out this week if you want to go check that out. And also we're going to be starting a new series interviewing CEOs around some interesting growth names, which will be started. It'll be a monthly feature, and we'll have that out to you as soon as we nail down the format, and which we hope to do in the next week or so. So with that, I'll let you go enjoy your early part of the week. Visit us at Mike on Money with any comments, questions, or suggestions, any topics you'd like us to cover. And I look forward to talking with you again next week. Thanks very much, everyone. Take care.